When it comes to investing, it often feels like standing at a crossroads, doesn't it? You've got two paths laid out before you, Vanguard and Fidelity. Both are giants in the investment world, but they represent very different philosophies and strategies. So how do you choose? Let's break it down together. First, let's talk about Vanguard. Now, if you're someone who values simplicity and a long-term approach, Vanguard might feel like a warm, inviting blanket on a chilly evening. They're renowned for their low-cost index funds, which is music to the ears of passive investors. The idea here is straightforward. You invest in a broad market index, and you let it do its thing over time. It's like planting a tree and watching it grow, without constantly worrying about how much it's sprouting each day. If you're in it for the long haul, Vanguard's philosophy aligns beautifully with the idea of time in the market, rather than timing the market. But let's not forget about Fidelity. If you're the type who thrives on action and is willing to dive into the nitty-gritty of the market, Fidelity might just be your playground. They offer a buffet of actively managed funds, which means there are professionals out there, analyzing, strategizing, and making investment decisions on your behalf. It's a bit like having a personal trainer for your finances. You want someone who's going to push you, challenge you, and help you achieve those potentially higher returns. Of course, with that comes the understanding that actively managed funds often carry higher fees, so you need to weigh whether those potential returns are worth the extra cost. Now, let's get personal for a moment. What are your investment goals? Are you looking to build wealth gradually? Or are you on a quest for that quick win? If you're aiming for steady growth without the stress of daily monitoring, Vanguard's low fees and simple approach might be the way to go. But if you're hungry for a more dynamic experience and you believe in the power of expert management, then Fidelity could be your ticket to potentially higher returns. And then there's risk tolerance. Are you the type who gets anxious at the slightest dip in the market? Or are you cool as a cucumber, ready to ride out the waves? Vanguard's index funds tend to be less volatile, making them a safer bet for those who prefer stability. On the flip side, Fidelity's actively managed funds can be more volatile, but they also provide the opportunity for substantial gains if the managers make the right calls. Let's not forget the importance of your time horizon. If you're investing for a goal that's decades away, like retirement, Vanguard's approach might resonate more with you. It's all about that long-term vision. However, if you're looking at a shorter time frame and want to capitalize on market movements, Fidelity's active management could align better with your strategy. So, what's the bottom line? Ultimately, choosing between Vanguard and Fidelity is a deeply personal decision. It's about understanding your financial situation, your goals, your risk tolerance, and your investment style. And hey, if you're feeling a bit overwhelmed, that's completely normal. It might be worth consulting with a financial advisor to help you navigate this decision. They can provide insights tailored to your unique situation and help you find the best fit. In the end, whether you choose Vanguard's steady hand or Fidelity's dynamic approach, remember that investing is a journey. It's about making informed choices that align with your financial dreams. So, take a deep breath, do your research, and trust yourself to make the right decision for your future. You've got this!